Hey guys, so let me give you a few seconds to take a close look at this chart right here. Now tell me, do you think this support level is going to break to the downside or bounce back to the upside? Okay, now take a look at this other chart at resistance. Do you think price will break above it or reverse and drop back down? Right. Now, here's the real question. How many times have you watched price respect support, respect it again, and the very moment you finally click buy, boom, support snaps like it was never there? Or resistance holds, holds, holds again, you sell, and suddenly price explodes straight through it. Here's the truth most traders never hear. Support and resistance don't break randomly. Smart money always leaves clues before every real breakout. And once you learn how to read those clues, support and resistance trading stops being a guessing game and becomes a high probability skill. So in this video, I'm breaking down my exact winning approach, the same clues I personally use to know when a support or resistance level is likely to break and when it's likely to hold. And trust me, the final clue is the one that completely changed my trading results. So without wasting much time, let's get into it. Let's start with why so many traders struggle with support and resistance. Where most traders get it wrong is simple. They treat support and resistance as exact lines, not zones. They assume price must react at one precise level. But in real markets, price can dip below support or reverse before it reaches a previous level. The same thing applies to resistance. So what happens? Retail traders end up buying support and selling resistance blindly. But smart money sees things very differently. They see support and resistance as zones of liquidity, and they always ask one question: is there enough liquidity around this area to move price? Liquidity at support or resistance means clusters of stop loss orders, pending buy and sell stops, and trap traders on the wrong side. So breakout traders place buy orders above resistance with stop loss right below it, and place sell orders below support with stop loss just above it. All these orders pile up around the same areas, forming liquidity zones. If the answer is yes, there is enough liquidity around the area, that level is in danger. If the answer is no, price is more likely to respect it. So before we even talk about the clues, you need to understand this. Breakouts happen when liquidity is engineered, and smart money always tells you before they move. You just need to know what to look for. Now, before a support or resistance level actually breaks, price usually goes through two distinct phases. The first phase is what they call the crawler move. This is when price slowly presses towards a level by forming higher lows into resistance or lower highs into support. This phase is all about absorption and liquidity building. It means orders are being taken in, but price is not yet ready to expand. The second phase is the power or momentum move. This is when you start seeing strong impulsive candles pushing into a support or resistance zone. You see big bearish candles driving into support or big bullish candles driving into resistance. Now here's the important part most traders misunderstand. A power move into a level does not automatically mean that level will break. In many cases, that momentum actually increases the chances of the level holding, because traders who are already in winning positions are more likely to take profits at that support or resistance, which often causes a sharp reversal in the opposite direction. However, when that momentum move happens after absorption and compression, and price fails to strongly reject the level, that's when a breakout becomes much more likely. Everything we're about to cover in this video happens before that final momentum move. So clue number one, Weak reactions at support or resistance. This is one of my favorite clues. When price hits a support or resistance level, what should you expect? Strong rejection, long wicks, and fast reactions, right? At support, strong rejection means price quickly reverses back upward. And at resistance, it means price sharply reverses back downward, okay? But when price is preparing for a breakout, something very different happens. Each reaction becomes weaker, the bounces get smaller, the wicks disappear, and price starts pressing into the level instead of bouncing away from it. Instead of sharp reversals, you'll notice progressive lower highs into support or progressive higher lows into resistance. Sellers keep pushing price down towards support, buyers keep pushing price up towards resistance. Price starts tightening, consolidating just above support or just below resistance, sometimes for hours. So this tells me one thing, that orders at that level are being absorbed. You can think of it like punching a wall. The first punch hurts, the second one weakens it, the third one creates cracks, and by the fourth punch, the wall breaks. That's exactly how support and resistance feel. Clue number 2. Multiple tests mean danger zone. Now, let me say this clearly because this alone can save you money. The more times a level is tested, the weaker it becomes. Support or resistance is usually strongest on the first touch. What retail traders are thinking is, wow, support has held 4 times, so this level must be strong. But smart money thinks liquidity is almost gone, so a breakout is loading. And that's exactly what happened in this Tesla chart on the 2-hour time frame. When I see price testing a level again and again and again 4 or 5 times in a short period, I know the buying or selling pressure is thinning out. And at that point, I stop buying support, I stop selling resistance. Instead, I prepare for the break. And here's the key. The final breakout often happens when traders feel most confident in that level. That's usually not a coincidence. Clue number 3, and this is where many traders get trapped. They see a weak poke through resistance and panic. But I don't focus on wicks, I focus on candle closes. Smart money uses wicks to grab liquidity, triggering stop losses and trapping traders before moving price in the real direction. But when candles start closing inside or beyond the level, that's a warning sign. And when multiple candles close tightly near a level, that's compression. Compression leads to expansion, and expansion usually means breakout. Clue number 4, volume behavior. Volume exposes intent. It confirms the strength of a move, suggesting if the momentum is strong or weak. When volume is low as price approaches support or resistance, it tells you conviction is fading. So here's what I look for. Low volume during pullbacks and increasing volume as price presses into the level. That tells me one side is weakening. Either sellers are weak or buyers are weak. But the biggest clue is seeing a volume spike at the level with little or no rejection. That means absorption is complete. And when price breaks after that, it usually runs hard. Clue number 5, identifying fake breaks versus real breaks. And trust me, smart money loves fake breakouts. Here's how I tell the difference. For fake breaks, I look for a fast spike above or below the level, long wicks, and immediate rejection. And for real breaks, I want to see a strong candle close beyond the level with little or no wick and a retest, then continuation. I never chase the first break, I wait for the retest. That's where probabilities explode in my favor. This is another example. You have a strong bullish candle closing above resistance, then pulls back to retest, and then a continuation. And here is another example But in this case, a strong candle closes below the level with a little wick, pulled back to retest, and continue to the downside. So here's my full process. First, I mark key higher time frame support and resistance zones. Then, I wait for price to test multiple times and look for weak reactions at that level. Next, I watch out for the closing candles and look for the candles tightening and compressing. Then I confirm everything with volume, expanding volume. This one is very crucial. And finally, I enter on the retest, not the breakout. This keeps me aligned with what smart money is doing, not fighting it. And the best part, I'm no longer emotional. The market tells me what it plans to do, and I simply react. Now, if this video changed how you see support and resistance, smash the like button. Comment smart money below so I know you watched till the end. And if you want real trading logic, not hype, make sure you subscribe. Remember, support and resistance don't break randomly. Smart money always leaves clues. You just need to watch out for them. I'll see you in the next one.